Welcome back to Wealthwise, the podcast where clarity meets actionable strategy for your financial future. I'm your host, Sarah, and if you're tuning in, you're likely someone who's serious about not just building wealth, but understanding the forces that shape it. Today, we're diving headfirst into a topic that's probably on a lot of minds right now: weathering the storm, smart investment strategies in volatile markets. In a world that often feels like it's spinning with geopolitical tensions, economic uncertainties, and a 24/7 news cycle that thrives on drama, how do you, the aspiring or established investor, navigate these choppy waters to protect and, yes, even grow your hard-earned capital? It's a big question, and to help us unpack it, I'm thrilled to have an exceptional guest. He's a seasoned market analyst, a voice of reason in often chaotic times, and the best-selling author of the acclaimed book, The Psychology of Investing in Crisis. Please welcome the insightful, the experienced Max Wise. Max, great to have you.
Thanks so much for having me, Sarah. It's a real pleasure to be here on Wealthwise.
The pleasure is all ours, Max. So by the end of this conversation, our listeners are going to walk away with some serious value. Specifically, we're aiming for you to discover, 1, why that gut reaction to follow the crowd, especially during market panic, can often be your biggest financial blunder. 2, we'll unpack the surprising historical data that shows just how resilient markets can be even after major crises. And most importantly, Max will be sharing actionable strategies and mindset shifts so you can learn not just to survive these periods, but to potentially thrive through them. All right, Max, let's jump right in. We're seeing it everywhere. Headlines blaring, social media buzzing with fear, predictions of doom and gloom. It's almost a constant barrage. Many people, especially those in our audience who are diligently building their careers and financial foundations, feel incredibly anxious. Some are even tempted to pull everything out of the market and just sit on cash. So my first big question to you is, why is this topic, managing investments during turbulent times, so often misunderstood? Why does this understandable anxiety so frequently lead to, frankly, poor financial decisions?
That's a fantastic question, Sarah, and it really hits the nail on the head because it touches on deep-seated human psychology. Our brains, at their core, are wired for survival. When we perceive a threat, and scary market headlines definitely qualify as a perceived threat to our financial well-being, our primal instincts kick in. It's that fight, flight, or freeze response. In investing, flight often translates to sell everything now. This is amplified by a few key factors. Firstly, social proof and herd mentality. We're social creatures. When we see others panicking, when our colleagues or friends are talking about selling, there's an immense pressure to conform. It's almost like a reverse FOMO, fear of missing out on getting to safety, even if safety is an illusion or a costly decision in the long run. The thinking becomes, if everyone else is running for the exits, they must know something I don't. Secondly, there are some pervasive and deeply ingrained misconceptions. People often believe that it's better to sell early and cut losses than to lose everything. Or they tell themselves, I'll just move to cash and wait for things to calm down, for the uncertainty to pass, and then I'll get back in. The problem with waiting for things to calm down is that historically, by the time the waters feel calm and the headlines turn positive, the market has already staged a significant recovery. Those best days, the sharp rebound days, often happen very quickly and when sentiment is still quite negative. If you're on the sidelines, you miss them. And missing just a handful of the market's best days can decimate your long-term returns. We'll probably touch on some data for that later. Let me give you a couple of real-world contexts. Think back to the global financial crisis of 2008. I remember it vividly. The fear was palpable. Banks were collapsing, people were losing their homes, their jobs. Many individuals I knew, even some seasoned investors, liquidated their portfolios near the bottom. They told themselves they'd get back in when there was more clarity. Well, that clarity took a long time to arrive in a way that felt safe,
And in the meantime, the market began one of the longest bull runs in history. They missed a huge chunk of that recovery because they were waiting for an all-clear signal that frankly rarely comes with a flashing neon sign. Or a more recent example, early 2020, with the onset of the COVID-19 pandemic. The speed and severity of that market crash were unprecedented. I mean, we saw major indexes plummet 30–35% in a matter of weeks. The narrative was overwhelmingly negative. Global shutdown, economic catastrophe. Many predicted a prolonged depression. And yet, for those who held their nerve or even systematically invested, the rebound was equally swift. Within 5 to 6 months, many markets had recouped all their losses and were heading to new highs. Again, those who panicked and sold locked in losses and likely missed that sharp V-shaped recovery because they were waiting for the uncertainty to completely vanish. So it's this potent cocktail of our innate psychological biases, the power of the herd, and some fundamental misunderstandings about how markets behave over the long term that makes this topic so critical and so commonly fumbled.
That's a powerful setup, Max. It's clear that our instincts, while designed to protect us in other areas of life, can really lead us astray when it comes to long-term investing. The idea that by the time it feels safe, the opportunity might have already passed is a crucial one. So, if our gut reactions and this common wisdom can be so misleading, what does the data actually tell us about market behavior during and after these crises? And more importantly, what concrete steps can our listeners start thinking about? I think that's the perfect lead into our core insights. So, Max, we've established that our natural human reactions, that urge to flee when things get scary in the markets, can often be counterproductive. You mentioned how waiting for clarity can mean missing out on significant recoveries. This leads perfectly into our first core insight. Many people assume that major crises like wars or deep recessions automatically spell long-term doom for the markets. What does history actually tell us about how markets react to these significant crises? Is it always as catastrophic in the long run as our immediate fears suggest?
That's a critical question, Sarah, because the narrative during a crisis is almost always one of impending, prolonged disaster, and it feels that way. But when we step back and look at the historical data, a more nuanced and often more optimistic picture emerges. It's not to downplay the severity of these events or the human suffering involved, but from a purely market perspective, the long-term impact can be surprisingly different from what our immediate emotions tell us. The key thing to understand is that markets tend to react most violently to unexpected news and to peak uncertainty. Once an event, even a terrible one, has actually occurred, a degree of that uncertainty is removed. The unknown becomes known, and markets as forward-looking mechanisms begin to discount the future, even if that future still looks challenging. Let's look at some concrete examples. You mentioned wars. Take the attack on Pearl Harbor in 1941. A truly shocking event that catapulted the U.S. into World War II. The S&P 500 dropped about 3% the next trading day. That's significant, but not an absolute collapse. And what's more telling is that the market fully recovered those losses within about a month. 1 month to recover from an event that signaled entry into the largest global conflict in history. Fast forward to a more recent geopolitical event, Russia's invasion of Ukraine in February 2022. The headlines were dire, filled with fears of escalation. On the day of the invasion, the S&P 500 did drop about 2.6%. But again, remarkably, within a month, the market had not only bounced back, but was actually trading higher than it was before the invasion started. It's a pattern we see, a sharp, immediate negative reaction as the news breaks, but often a surprisingly swift stabilization and recovery once the initial shock wave passes and the new reality, however grim, begins to be priced in. It's not just wars. Think about other types of crises. The 9/11 terrorist attacks in 2001. The U.S. stock market was closed for almost a week. When it reopened, there was a steep sell-off. The S&P 500 fell roughly 11.6% in 5 days, the Dow about 14%. It was one of the worst weeks in market history up to that point. The fear was immense. Yet even then, stocks recovered most of those losses within about 2 weeks, and certainly within a few months, they were back on an upward trajectory. And then, of course, the COVID-19 pandemic in early 2020. That was the fastest bear market in history. The S&P 500 plunged 34% in just 33 days.
It felt like the world was ending. Businesses were shutting down, economies were grinding to a halt, but as governments and central banks stepped in with massive stimulus, and as we began to understand the virus better, the market staged an incredible recovery, hitting new all-time highs within just 5 months. The common thread here, the crucial insight, is that investors despise uncertainty more than almost anything else. Once the future becomes a little clearer, even if that clarity reveals a difficult path ahead, markets tend to stabilize and begin the process of moving forward. The worst fear is often the fear of the unknown. Once the unknown becomes known, even if it's bad, the market can start to digest it.
That's a really powerful perspective, Max. The idea that markets react more to the uncertainty than the event itself, and that recovery can be quicker than anticipated, is quite counterintuitive to what many feel during those times.
Absolutely. It's a testament to the forward-looking nature of markets, and dare I say, the underlying resilience of economies and human innovation over the long term.
Markets often price in fear beforehand. When the bad news actually hits and the initial shock subsides, the recovery can be faster than you think. Okay, Max, so if history shows markets can be surprisingly resilient and recover, that might tempt some listeners to think, great, I'll just sell when things look scary and then jump back in when it feels like the bottom to catch that recovery. We hear about buying the dip all the time. So if markets do tend to recover, is trying to time these events, selling high before the bad news really hits and buying back at the absolute bottom, a wise or even feasible strategy for the average investor or even for professionals like yourself?
That, Sarah, is the multi-million-dollar question, isn't it? And the short answer, for the vast majority of people, including seasoned professionals, is a resounding no. Timing the market perfectly sounds incredibly appealing in theory. Who wouldn't want to sell at the peak and buy at the trough? But in practice, it's exceptionally difficult, if not outright impossible, to do consistently. It's often described as a fool's errand. There are a few reasons for this. Firstly, to successfully time the market, you have to be right twice. You have to correctly identify the peak to sell, and then you have to correctly identify the bottom to buy back in. The odds of getting both of those decisions right consistently over an investing lifetime are infinitesimally small. Emotions play a huge role here. When markets are crashing, fear is at its peak. It's incredibly hard to pull the trigger and buy when everyone around you is panicking and the headlines are screaming disaster. Conversely, when markets are euphoric and at their highs, greed takes over, and it's hard to sell when it feels like the party will never end. Let me share a classic illustration that really drives this point home. It's based on research, often adapted by personal finance educators, looking at 3 hypothetical investors. Let's call them Tiffany, Brittany, and Sarah. Brittany is a market timing genius. She somehow has perfect foresight. She saves her money and only invests her accumulated sum at the exact bottom of every major market crash. She waits for the lowest point, then boom, invests everything. Tiffany, on the other hand, has the worst luck imaginable. She invests all her savings right before each of the biggest market crashes. Think the dot-com bubble, the 2008 financial crisis, the COVID crash. Every single time she buys at the peak just before the plunge. Then there's Sarah. Sarah doesn't try to time anything. She sets up an automatic investment of, say, $500 a month into a broad market index fund, like an S&P 500 ETF. She started this in, let's say, 1985, and just kept doing it, month in and month out, through every up, every down, every crisis, every boom, for nearly 40 years. Now, what do you think the results were? Most people would assume Brittany, the genius market timer, would be miles ahead. But the results are often astounding. In many versions of this study, Sarah, the consistent, disciplined investor who never tried to time the market, ends up with the most money. For instance, she might end up with around $3.5 million. Brittany, the genius, might have around $3.3 million. And here's the kicker. Tiffany, with the absolute worst timing imaginable, still ends up with a very substantial sum, perhaps around $2.1 million from her initial $240,000 invested over those decades. How is this possible? It's because Sarah's money was always working for her. She benefited from time in the market and the power of compound interest consistently. Even though Brittany got a higher return on the money she invested at the bottoms, she had less money working for her overall for shorter periods, missing out on some compounding. And Tiffany, despite her terrible timing, did the most important thing. She stayed invested. She never sold in a panic. And that alone allowed her to still build significant wealth. And there's another crucial piece of data related to this, often cited from firms like JP Morgan Asset Management. It shows the cost of missing the market's best days. For example, if you had invested $10,000 in the S&P 500 and just left it alone from, say, 2003 to 2022, your money would have grown to something like $64,800. But if you missed just the 10 best days in the market over that 20-year period, your return would have been slashed almost in half to maybe around $29,700. If you missed the 20 best days, you'd be down to perhaps $18,000, barely any growth at all. And here's the real kicker. The market's best days often come very, very close to its worst days. They frequently occur during periods of extreme volatility right after a big sell-off, as the market begins to rebound. So, if you panic and sell during a crash, you almost invariably miss that powerful rebound.
That's fascinating, Max. The Sarah, Brittany, and Tiffany example is so illustrative, and the data on missing the best days is truly sobering. It highlights that the risk isn't just being in the market during a downturn, but the risk of being out of the market when it turns around.
Precisely. You're trying to catch a falling knife and then perfectly time its relaunch. It's a recipe for underperformance for most people. The focus should be on consistency and long-term participation.
Stop trying to find the bottom. Focus on the journey. Time in the market consistently beats timing the market. Okay, Max, this is all incredibly insightful. We've established that history shows market resilience, and we've debunked the myth of consistently timing the market for success. So this brings us to the really practical part for our listeners, many of whom are in their 20s and 30s, actively building their careers and trying to make smart financial decisions for the long haul. Instead of trying to outguess the market or panicking during volatility, what are the concrete, actionable strategies they should be focusing on to build a robust portfolio and, just as importantly, a resilient mindset to navigate these inevitable storms?
This is where the rubber meets the road, Sarah. And the good news is the most effective strategies are often the simplest and most disciplined, not the most complex or reactive. It boils down to having a sound plan and sticking to it. First and foremost, embrace dollar cost averaging, DCA. We saw this with our hypothetical investor, Sarah. This means investing a fixed amount of money at regular intervals, say monthly or bi-weekly, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, like during a downturn, that same fixed amount buys more shares. Over time, this averages out your purchase price, reduces the risk of investing a large lump sum at the wrong time, like poor Tiffany did, and crucially, it automates the process of buying when things look scary, which is psychologically very hard to do manually. For young investors with a long time horizon, DCA into broad market index funds, or ETFs, is a cornerstone of wealth building. Second, diversification. It's the only free lunch in investing, as they say. Don't put all your eggs in one basket. This means spreading your investments across different asset classes: stocks, domestic and international, large cap, small cap, bonds, perhaps some real estate, maybe through REITs if direct ownership isn't feasible yet. And for those with a higher risk tolerance and understanding, even a small allocation to alternatives like cryptocurrencies. The idea is that different asset classes often perform differently under various market conditions. When one is down, another might be up or stable, smoothing out the overall ride of your portfolio. Third,
Maintain an adequate emergency fund in cash. This is absolutely critical, and it's not for market timing. This is your safety net for life's unexpected events: a job loss, a medical bill, an urgent repair. Having 3 to 6 months worth of living expenses in an easily accessible, safe place means you won't be forced to sell your long-term investments at an inopportune time, like during a market crash, to cover a short-term need. This fund provides peace of mind and allows your investments to stay invested and do their work. Then, separate from your emergency fund, you might strategically keep a little extra dry powder or cash on the sidelines if you have a plan to deploy it during significant market dips, but this should be part of a predefined strategy, not an emotional reaction. Fourth, and this is perhaps most important from a mindset perspective, maintain a long-term focus. Investing, especially in equities, is a marathon, not a sprint. If you're in your 20s or 30s, your investment horizon is likely decades long. Market downturns, recessions, crises, these are all normal parts of the economic cycle. Look at any long-term chart of the stock market. It's a series of jagged upward movements with plenty of scary drops along the way. But the overall trend has been unequivocally up. If you're investing in fundamentally sound businesses or broad market indices, history strongly suggests that patience will be rewarded. Don't let short-term noise derail your long-term plan. When the market is down 20%, it's uncomfortable, but ask yourself, will this matter in 20 or 30 years if I stay the course? Likely not as much as you think in the moment. The overarching insight here is to control what you can actually control. You can't control geopolitical events, economic data, or daily market fluctuations, but you can control your savings rate, your investment strategy like using DCA, your asset allocation, diversification, your costs, choosing low-fee funds, and most importantly, your own behavior and emotional reactions. Don't let fear or greed dictate your financial decisions. Stick to your plan.
That's a fantastic checklist, Max. DCA, diversification, emergency fund, and that unwavering long-term focus. It brings a sense of empowerment back to the investor, focusing on their actions rather than market chaos.
Exactly. It's about building a robust system that can withstand the storms, rather than trying to predict when the storms will hit or how severe they'll be.
In investing, consistency and discipline in your own actions often yield far better results than attempts at momentary brilliance or predicting the unpredictable. Max, everything you've shared, the historical data, the behavioral pitfalls, the practical strategies, it's all incredibly valuable. But theory and data are one thing, lived experience is another. I'm sure throughout your distinguished career as an analyst and investor, you've personally navigated some incredibly choppy market waters. Was there a particular moment, perhaps a significant mistake or a profound breakthrough, that fundamentally changed how you view investing, especially during times of crisis? A turning point that really cemented these principles for you?
Oh, absolutely, Sarah. There are always moments that stick with you, that shape your philosophy far more than any textbook could. For me, one of the most formative periods was undoubtedly the global financial crisis of 2008. I wasn't brand new to the industry, but I was certainly younger, perhaps a bit more impressionable by the sheer weight of market sentiment than I am today. I remember it so vividly. It felt like the entire financial system was teetering on the brink of collapse. Lehman Brothers had failed. Bear Stearns was gone. AIG needed a massive bailout. These were titans, institutions we thought were infallible. The fear in the air was thick, almost suffocating. Every headline screamed disaster. Every conversation was laced with anxiety. My own gut, that primal instinct we talked about earlier, was screaming at me, sell everything, get to cash. This is different. This is the big one. I saw colleagues, some with far more years in the market than I had, capitulating. They were selling, locking in losses, just to make the pain stop, to feel some semblance of control in a situation that felt utterly out of control. And believe me,
The temptation to join them was immense. It's incredibly difficult to stand firm when the entire world around you seems to be stampeding for the exits. You start to doubt your own analysis, your own convictions. What if they know something I don't? What if I'm the fool for holding on? Around that time, I had a mentor, an older gentleman who had weathered many market storms in his long career. He was a beacon of calm in that chaos. I remember having a conversation with him, probably looking quite panicked myself, and he looked at me very calmly and said something I've never forgotten. He said, "Max, always remember, the stock market is a device for transferring money from the impatient to the patient." That sentence it cut through the noise. It resonated so deeply. It wasn't about complex algorithms or predicting the next economic print. It was about a fundamental human behavior, patience versus impatience. So, I went back to my desk. I looked at the companies I was invested in, the fundamental reasons I had invested in them in the first place. Had those long-term fundamentals truly evaporated overnight? For many of them, the answer was no. Their businesses were still sound, albeit facing a hurricane. The price of their stock had plummeted due to fear, not necessarily a complete destruction of their underlying value. It was one of the hardest things I've ever done professionally, but I made a conscious decision not to sell my core long-term holdings. In fact, where I had the capacity and where the valuation seemed ludicrously cheap, based on my analysis, I actually, very cautiously, bought a little more. It felt like walking into a burning building. My hand was literally shaking as I placed some of those buy orders. Every fiber of my being wanted to run the other way. And then we waited. The market didn't turn around overnight. There were more scary days, more false dawns, but eventually, slowly, painstakingly, the recovery began. And those investments, the ones I held onto through the inferno, the ones I even added to, not only recovered, but went on to generate significant returns in the years that followed. That experience wasn't just a financial win, it was a profound psychological breakthrough. It taught me, in a way no book ever could, the true power of conviction, based on sound analysis, the incredible importance of a long-term perspective, and the absolute necessity of emotional discipline, especially when it's hardest to find. It cemented in me the belief that often your greatest opportunities are disguised as your greatest fears. And that mentor's words, they became a bedrock of my investment philosophy. Since then, I've always reminded myself and advised others, when panic is at its peak, that's precisely when your rational mind needs to be at its clearest.
Wow, Max, that's a powerful story. The stock market is a device for transferring money from the impatient to the patient. That's going to stick with me, and I'm sure with our listeners too. Thank you for sharing that so openly. It really brings all the theory to life. Max, drawing on that wealth of experience and your insights into market behavior, let's shift our gaze forward a bit. We've talked about navigating current volatility. If you had to look out over the next, say, 3 to 5 years and identify one major trend, shift, or perhaps even a critical skill set that you believe will significantly define financial success for individuals, especially in the context of ongoing potential uncertainties, what would that be?
That's a great forward-looking question, Sarah. If I were to pinpoint one overarching trend that I believe will be increasingly crucial, it's the rise of knowledge-driven financial self-sovereignty. Let me unpack that a bit. We live in an age of information overload. There's no shortage of financial gurus, instant experts on social media, and an endless stream of hot tips and dire predictions. It's incredibly noisy, and frankly, a lot of it is designed to prey on those very emotions of fear and greed we've been discussing. In this environment, the ability for an individual to cultivate their own deep understanding of core financial and investment principles, to critically evaluate information, and to build an unwavering emotional discipline will become paramount.
It's about moving beyond passively receiving advice or reacting to headlines, and instead actively equipping oneself with the knowledge to make informed, rational decisions aligned with one's own long-term goals. So what does this look like in practice? It means individuals taking the time to truly understand concepts like asset allocation, risk management, the power of compounding, and the historical behavior of different asset classes. Not just knowing the definitions, but internalizing how they apply to their personal situation. It means developing the skill to filter out the noise, to discern credible analysis from speculative hype. It means building the emotional resilience to stick to a well-thought-out plan even when the market is going haywire or when a new get-rich-quick scheme sounds incredibly tempting. Think about it. AI and algorithms can provide incredible analytical support, and they will continue to evolve and become more sophisticated. They can help us process data, identify patterns, and even execute trades. But AI cannot, as yet, replicate true wisdom, long-term strategic thinking rooted in personal goals, or that crucial human element of emotional discipline in the face of fear or euphoria. The final decision, the commitment to a strategy, the courage to stay the course, that still rests with the individual. So in the next 3 to 5 years, I believe those who invest in their own financial literacy, who prioritize understanding why they are investing the way they are, and who cultivate that internal locus of control over their financial decisions will be the ones who not only navigate uncertainty more effectively, but also achieve more sustainable and meaningful financial success. The greatest competitive advantage in the coming years won't be access to a secret algorithm, but the self-mastery that comes from genuine financial understanding and emotional fortitude.
Knowledge-driven financial self-sovereignty. I love that. It's empowering. It puts the onus on us as individuals to become educated and disciplined rather than just outsourcing our financial future to the latest trend. A very forward-thinking perspective, Max. Well, Max, this has been an incredibly enlightening and, I think, reassuring conversation. From understanding the historical resilience of markets to recognizing the pitfalls of emotional reactions and market timing, to the actionable strategies like dollar-cost averaging and diversification, and finally that powerful personal story and your forward-looking insight on financial self-sovereignty. You've given us so much to think about and, more importantly, to act upon. Thank you so, so much for sharing your wisdom with the WealthWise community today.
It's been an absolute pleasure, Sarah. Thank you for having me and for asking such thoughtful questions.
The pleasure was all ours. And to all of you listening, if today's deep dive into navigating market volatility resonated with you, if you found value in Max's insights, we'd love for you to do 3 simple things. 1, share this episode with a friend, a family member, or a colleague, anyone you know who might be feeling anxious about their investments or who could benefit from a dose of long-term perspective. 2, subscribe to WealthWise wherever you get your podcasts. We have more conversations like this one coming your way every week, designed to bring you clarity and actionable strategies for your financial journey. And finally, we'd love to hear from you. What was your biggest takeaway from today's conversation with Max Wise? Drop a comment if you're listening on a platform that allows it, or connect with us on our social channels. Your feedback helps us shape future content. Remember, building wealth, especially in uncertain times, isn't about having a crystal ball. It's about having a sound strategy, the discipline to stick with it, and the wisdom to focus on what you can control. As we close out today's episode, I want to leave you with this thought, one that I believe Max would wholeheartedly agree with. Financial freedom isn't just a dream, it's a strategy, consistently applied. Thanks for tuning in to WealthWise. I'm Sarah. Until next time, invest wisely and live well.